I want to consider multi-strategy investing, how to diversify your portfolio in order to maximize returns. A multi-strategy investing essentially involves using a variety of investment strategies within a single portfolio to achieve a diversified risk and a return profile. You want to diversify your risk profile, your return profile within a single portfolio. Then you adopt this particular strategy. This approach, allows investors to benefit from different strategies, strengths, and um, and um, and the same process. By so doing, you you kind of mitigate the weaknesses of any single approach. In other words, you harness the strengths of a given approach and as well as mitigate the weaknesses of that particular approach or those strategies of investing. So the key features of multi-strategy investing include number one, diversification. It combines, multiple investment strategies such as equity, long shorts, market neutral, event-driven, macro strategies to spread risk and enhance returns. Look at the strategies there: equity long shorts, market neutral, event-driven, macro strategies. All these strategies are utilized to be able to spread, diversify your risk, and as well as enhance your return potentials. Another item is flexibility. Flexibility here, managers can adjust their strategies based on market condition. Whenever market condition changes, they are bound to equally alter their strategies to keep abreast of existing market conditions. This is aimed to capture returns from various sources. It's kind of flexible, and the flexibility here introduces different sources and different strategies, and you are bound to capture returns from these sources and as well as from these separate strategies. The number three there is risk management. By employing different strategies, the portfolio can potentially reduce risk. It can mitigate overall risk and smoothen out returns at the end of the day. This is followed by dynamic allocation. Allocations to different strategies can be adjusted over time to respond to changing market conditions as well as an economic environment. So there's that dynamism when it comes to asset allocation. Everything is based on what? Is based on the nature of the market. You have that particular leeway to be able to, to change your strategies, to adapt different strategies to be able to cope with the ever-present changes in the market environment. So let's look at the common strategies that could be utilized in this particular investment principle. You have equity long short, involving taking a long position in an undervalued stocks and taking a short position in an overvalued, in an overvalued security. So that is you are a long-term investor, and at the same time you are a short term kind of, you short the market. You can go long and you can as well as go short on securities in the market. So you operate like Jim Chanos, the popular, you know, uh, investor that does, that short stocks. You currently have market neutral. It aims to balance long and short positions to minimize exposure to market movements. So you have enough shorts and enough long positions to be able to manage, to be able to like neutralize or mitigate fluctuations in the markets, to be able to have stable returns despite the nature of returns in the markets. If some companies do poorly, you still gain. Some companies perform profitably, you still stand to gain. You know. So there's this event-driven strategy inculcated into it. So it focuses on opportunities arising from corporate events such as mergers, acquisitions, or restructuring. Is a strategy that could be inculcated into the overall, multi-strategy investing. So you key into event driven. I think I have a video on event driven investing. There's that, you pay attention to macro events. So this involves making investment decisions based on macroeconomic trends and forecasts. In this case, you consider macroeconomics. You are essentially an economist as well as an investor. So you consider economic circumstances, macroeconomic events and occurrences. So you could equally benefit from forecasts of this nature. I equally want to consider the disadvantages of this particular strategy. Number one advantage is greater diversification and risk management. You have an opportunity of diversifying your investment across different strategies, and by so doing, you tend to minimize your risk. Your risk is better managed. There's that potential to capture returns from various market conditions and strategies, because you're investing in different strategies in different market conditions, so you can harness returns from these different markets and strategies. There's flexibility to adapt to changing markets and economic conditions. You are nimble very easily, and you're flexible, so you can adapt to changes in the market, and you can equally profit or gain or benefit from changes in the market. Let's look at the disadvantages. So it involves complexity in managing and understanding multiple strategies. You must be a genius to be able to juggle all these strategies at the same time. It's for experienced, skillful investors. So there's that potentiality for higher fees due to the use of multiple strategies and management teams. So the fees involved here is relatively high, because it involves different managers, different strategies. So these layers of management and strategies will attract higher fees. You equally have that requirement. It requires active oversight and adjustments of strategies. You have to really monitor your investment carefully, so as to be able to introduce adjustments here and there whenever necessary. So look at examples. Example use cases involve: number one, you have hedge funds. They adopt these strategies a lot. Multi-strategy hedge funds. You have institutional portfolios. Large institutional investors use multi-strategy investing to diversify across different asset classes and strategies. You equally have diversified investment funds. Some investment funds that are duly diversified incorporate this strategy into their investments. So the individual investor can equally, in a way, benefit from this particular strategy by buying into hedge funds or institutions that utilize these investment strategies.